Ever wondered how companies track their profits and financial health? Today, we'll break down two key financial statements, the balance sheet and the profit and loss statement, P&L, in the simplest way possible. Let's dive in. What is a balance sheet? A balance sheet is like a financial snapshot of a company at a specific moment. It shows three key elements. 1. Assets, what the company owns, cash, inventory, equipment. 2. Liabilities, what the company owes, loans, unpaid bills. 3. Equity, the remaining value after subtracting liabilities from assets. Think of it like your personal finance. If you own a house worth $500K but have a mortgage of $300K, your equity is $200K. What is a P&L statement? A profit and loss. P&L statement shows a company's income and expenses over a period of time, monthly, quarterly, or yearly. It includes revenue, money coming in from sales. Expenses, costs like salaries, rent, and marketing. Profit loss. If revenue's expenses, it's a profit. If not, it's a loss. Imagine you run a coffee shop. You make $10,000 in sales but spend $7,000 on rent, coffee beans, and staff salaries. Your profit is $3,000. Quick comparison. Balance sheet. Snapshot of a company's financial position at a given time. P&L statement. Tracks financial performance over time. Think of it like a health report. Balance sheet. Blood test results. Static view. P&L statement. A heart rate monitor. Dynamic view.